Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Tiffany of PIMCO is going to join us in the meantime. Tiffany, welcome to the programme. Is the door still open for a rate cut in September?
Yeah, I think the CPI was completely in line with expectations. How we've characterized the sort of tariff-related pass-through, the evidence is that it's happening, but it's happening slower than I think many people expected, going back to April when the more dramatic tariff announcements were first implemented or announced. It's happening more slowly, and across industries, it's more uneven. So I think the broader story here that we're still seeing is that it's very concentrated within goods. It's happening slowly. And outside of that, inflationary pressures look very manageable. So I think for a Federal Reserve, that is a very good sign. In addition to that, there's, I would argue, better news in terms of the so-called second round effects with higher prices leading to higher wages and getting more into the inflationary process. We've actually seen inflation expectations from various surveys start to moderate. The University of Michigan survey, which we'll get later this week, the longer-term inflation expectation index for that one had accelerated more, but it's moderated more recently. So I think all of this points to, a central bank that can get on with normalizing policy rates back to neutral.
And Tiffany, something we've been exploring throughout the whole of this morning, and to be fair, over the last several months, is whether the tariff story is delayed by the fact that we've seen fantastic inventory management from some of the retailers at the moment, and that maybe we haven't seen the full extent of this. When would you get comfortable that we've seen the limits of it all?
Yeah, I think we expect a good portion of the pass-through over the next several months. But I think the bottom line is that companies have room. It appears that companies have room as a result of still high margins coming out of the pandemic. Companies have room to sort of more slowly pass this on to consumers. And so what that means is that, goods inflation could be a little bit more persistent over time, but you're not necessarily going to have that bigger surge that many people expected as you get that faster price level adjustment this year. So I think for the Fed, I think that's all good news. The other thing that we see when we look at, a range of data, is that companies so far are absorbing, we think, the lion's share of the additional costs of tariffs. And as I mentioned, they can do it. Their margins were elevated post-pandemic. That has remained the case. And so they do have room here. At least the largest companies have room to sort of manage this process. And we think that's what they're doing. The other thing is the tax legislation that was recently passed, the One Big Beautiful Bill, that is, reducing the effective tax rates for a lot of companies, especially those companies that are capital intensive. They invest a lot. They're getting, upfront expensing tax credits, and that will help offset the impact of the tariffs as well. A lot of those tax credits were retroactive for 2025. So all of that just means that companies do have a little bit of flexibility here and can manage the pass-through rate.
So, Tiffany, are you basically saying that because of the One Big Beautiful Bill, companies are able to eat more of the higher tariffs from this administration?
Yeah, I certainly think that that's the case. Now what we estimate in terms of the tax savings in aggregate for 2025 is around 150 billion. The tariff tax collections that are happening, we annualize at about 350 billion. So the tax legislation is not completely offsetting the additional taxes paid by tariffs, but it certainly is in mitigating some of it. And so that's why, we've argued you'll still see, we think, some pass-through of higher tariffs onto prices. You'll get some price adjustment. But we think the risk here is just that it takes longer than many people are expecting. And the inflationary effects of this in the back half of this year are somewhat less. And again, that just sets the Federal Reserve up to continues to restart its cutting cycle to get back ultimately to neutral policy rates.
Tiffany Wilding of PIMCO. Tiffany, thank you. David Kelly at JPMorgan Asset Management with us around the table. David, good morning.
Morning.
Not going to ask you that question. Just want to ask you the following. When will you be comfortable that we've seen the limits of this? How many more months of data do you need?
Oh, we're just getting started. I mean, what we saw today was plenty of inflation without tariff effects. We didn't have a big increase in new car prices. We didn't have a big increase in apparel prices. But let's look at where we did see an increase. Airline fares have come down a lot because the airline industry was very weak. But if you look at the recent data on people going through TSA checkpoints, it's firmed up. And so domestic airline travel is now back on a positive year-over-year basis. We've got a lot of fiscal stimulus going to kick into the economy early next year. But also in the tariffs, even in July, we saw a lot of money collected, but it still equates to about a tariff rate of about 8%. We think this whole tariff rate is going to go up to about 14.5% measured by that later. So we've got most of this tariff increase still ahead of us in terms of just affecting the data. And then, people say, oh, the retailer's going to eat it. No, they're not. They just wrote the check. So of course it looks like they're eating it. Walmart writes a check, but eventually they're going to pass it on. And yes, they've got good margins, but how do they manage to sustain these margins? Because they're great at figuring out how to stiff consumers, and that's what they'll do. And so this thing will feed through. It's just a matter of a number of months. And inflation's going up, but it's going up very steadily, and it will be above, we think, about 3.5% in CPI by the end of the year.
You've made two important points here. One is that you believe that goods prices will continue to firm through the year ahead, and that you're not going to see an offset from services. Is that right?
That's correct, because what's going to happen is the economy is going to be slower in the second half of this year as this goods inflation feeds through. But the big kicker here that people are not talking about is the huge rush of income tax refunds that's going to kick in at the start of next year. It's going to be like an extra stimulus check. And that, we've seen what happens. You give him a cookie, he's going to want a glass of milk. You give an American consumer a stimulus check, they will spend it. And you're going to have a surge of spending in the first half of next year with limited supply because of all these tariff and supply chain disruptions. You are going to get a second round of inflation, which is going to sustain inflation well above 3%, which begs the question of, why again is the Fed cutting?
Well, that was
if inflation's heading the wrong way slowly.
That was my next question to you. What does the Fed do with this kind of data?
They should stay on hold. I think there's very little argument that in favor of the Fed cutting rates. Rates are not abnormally high. I don't know why they think 3% is a neutral rate in the long run. It doesn't equate to history before the pandemic. I think something 4.5% is more of a neutral rate anyway. But there is no urgency about cutting rates. Now, I think they will cut rates for political reasons, which is very unfortunate, but I don't think they should based on these data.
As you're talking, traders are actually adding to bets of September Fed rate cut because this basically came in line when it comes to inflation. But why for political reasons when actually we saw a trend, 3 months of not so great unemployment numbers?
Well, yeah, but if you look at the overall mosaic of employment, it's still growing. And remember, we've got a labor supply problem too. And one of the things that Jay Powell pointed out is he's not looking at payroll growth. He's looking at the unemployment rate. If we've got fewer jobs being created, but we've got fewer workers, then you've still got a certain amount of inflationary pressure. You just said that the growth potential of the economy has gone down. Well, they can't do anything about that. So if you're not, this economy is not going to spark a huge surge in unemployment. And I think the basic point is by the end of the year, we think maybe 4.5% unemployment. We think over 3% in inflation. They're missing their inflation target by more than unemployment. Therefore, they shouldn't be cutting.
Just tallying this up, though, but you believe they will be cutting. So you've got a Federal Reserve cutting interest rates at a time when inflation is picking up. And the key phrase you used was second round effects. You don't believe this is a one-off. You're actually going to see second round effects in the first half of 26. Yeah. What's your market view on top of that?
Well, so I think the market view is not too bad because I think for political reasons, I think unfortunately the Fed will cut twice this year, maybe 3 times next year. They'll get going and cutting. It's not going to really change the economy that much. But if you bring bring short rates down enough, it does push extra liquidity into the equity market. And so you could just maintain these bubbly asset markets. I mean, what we've got is a tortoise of an economy and a hare of a market. And we're just giving more sugar to the hare.
That's the stock story. What about the fixed income story for bonds? Because we've had guest after guest come on this program and say, get ready for a steeper yield curve. They go aggressive at the front end, you're going to see yields lower. At the long end, you're going to see a questionable development.
Well, it's again, it's hard for a tortoise-like economy to generate a really steep yield curve. So, but I think you could see rates move up a bit. I wouldn't be long duration here because I don't think this economy is going to go into recession. I think by the time the tariffs really hit, we're going to be on the verge of fiscal stimulus because of this income tax refund thing, and that will keep this economy moving forward. And if the economy is moving forward, you've got inflation printing at 3, you shouldn't really have a long bond lower than 4.2.
What do you think inflation is going to peak at in the next 12 months?
I think CPI is going to peak at about 3.5% and then hang there between 3.5% through about June of next year. And then finally it's going to come down again because this is sugar. These income tax refunds, it's a sugar rush. It's not protein. It will wear off. And then by the end of next year, then I think the economy is finally cooling again. Unless, of course, you get some more stimulus. And that's really the problem because if the Fed keeps on cutting rates whenever the other side of Washington asks them to, then it enables more and more rounds of fiscal stimulus to always keep this economy a little bit too hot. So it's not it's called inflammation. Doctors don't like it.
David, it's good to hear from you. It's the latest this morning. Chinese authorities urging local companies to avoid using NVIDIA's H20 chip. Sources telling us here at Bloomberg that firms are being discouraged from using the chips, especially for government-related purposes. Joining us now to discuss is Jon Lieber of Eurasia Group. Jon, welcome to the programme, sir. I just wonder what the end game is here for the Chinese and what ultimately they're trying to achieve.
I think the end game is that the Chinese want to have their own chip. And they don't want to be dependent on the U.S. tech stack. And that's one of the reasons that Trump allowed these H20 exports was because he bought into the argument that if the U.S. dominates chip technology and if the Chinese learn to rely on that in their own technology stacks, then it gives the U.S. more power, not less here. And I think the Chinese recognize that argument. It's somewhat valid. And so what they want to do is encourage people not to use the American tech. And they know also how vulnerable they are to things like the foreign direct product rule and the other rules that the U.S. has used to weaponize their own technology supply chain over the past several years. And now that's the long-term game here. I think the H20 is just one part of that. But technological development is going to determine what happens here, not necessarily export controls.
Jon, when it comes to NVIDIA and AMD selling these chips, getting these export licenses to go back into China, what kind of pushback have you heard in Washington from both individuals who are questioning whether the 15% revenue cash back to the United States is legal and the China hawks as well in the Trump administration?
Yeah, I mean, the 15% revenue take makes it look like to certain people, and I think this is a valid argument, that national security is now for sale. I'm sure a lot of companies would be very happy if they had the opportunity to buy their way out of U.S. regulations that otherwise ban them from doing business. In a way, this is a version of a carbon tax where you're you're purchasing the right to pollute. But here, you're purchasing the right to undermine America's national security by selling these chips to the Chinese, which a lot of China hawks in Washington are not happy about because they believe that this is enabling Chinese technological development. This is contrary to the policy of the Biden administration and up until last week, the policy of the Trump administration, which was, of course, to deny the Chinese access to these chips. So this is a very controversial move. It's never been done before, as far as we're aware. And Trump's getting a lot of pushback, both from the security hawks and also people who argue this is an illegal export tax, which I'm pretty confident they'll find their way around. But this is something new we've never seen before.
Do you think this is a one-off, or we're going to see more policy like this?
That's a good question. I think we don't know yet. I don't think there's a lot of areas where this type of thing is doable, where you've got an export ban that somebody wants that they're offering the chance to raise some revenue off of. So I'm not sure where else we could see it, but we still have, one of the things that's really surprising to me to remember all the time is there's still 3.5 years left in this administration, and we know Trump loves to do these types of deals. So it wouldn't surprise me to see this show up in other areas. It's just hard to predict which ones yet.
Well, Jon, let's talk about what we learned from the first term under President Trump. In Trump Volume 1, there was a coherent ideology governing trade policy, whether you liked it or not. I happen to be sympathetic to the concerns they had about reciprocity in a country like China, who'd put barriers to entry up all over the place. Jon, now I'm struggling with what the framework is exactly this time around. How are you explaining this to people at the moment?
Yeah, I mean, a huge difference between this term and last term is you don't have the strong personality of Robert Lighthizer directing a lot of Trump's trade policies. What you have instead is the strong personality of Donald Trump directing these policies. And Trump is going every which way. And, it's obvious that in some cases, he's motivated to get a deal. We saw that with all these countries pre-August 1st. And in other cases, you see personal relationships starting to sour and take over the ability for the U.S. to cut deals, like what's happening with the U.S. and India right now. I think at the core of it, though, Trump remains a very transactional guy. He's somebody that wants to see higher tariffs, and he's somebody that wants to do deals in order to keep those, in order to get those tariffs. With China, they've been able to leverage their use of rare earths to and critical minerals to great effect. The U.S. national security community is in a panic about its ability to build weapons in the United States because of the choke points that China's been using to deny the U.S. those critical minerals. And Trump himself, and that's driving a lot of the China policy right now. So I don't think there's a consistent strain that you can pull through here, but it is worth pointing out that Trump ran on a campaign of higher tariffs, and now the U.S. is getting them with an average effective rate somewhere in the mid to high teens, and that's a huge shift that reflects Trump's own personality and his own policy preferences.
Well, let's just sit on that transactional nature. Nothing new, quite well understood. Where people struggle is what defines whether it's a good transaction or a bad transaction, and what kind of feedback loops is the president sensitive to?
Well, clearly he's sensitive to feedback from the private sector. I mean, the reason that the Liberation Day tariffs were paused in the first place was because of what he called the yippiness in the bond market. So that's one type of feedback. Another type of feedback he's clearly sensitive to is direct feedback from the business community. His meeting with Jensen Huang directly led to the selling of these H20 chips into China. And I also think that he's sensitive to the positive feedback he's getting from the deals that are happening, where his U.S. trading partners aren't putting up any real resistance here. Nobody's retaliating. I think that's an important point, is that he's faced virtually zero retaliation, and that's allowed him to get away with these higher tariffs. And I think going forward, the feedback that might cause him to reverse course would be economic weakness, major complaints from the U.S. business community, big businesses who are going to have the ear of the president. And I think that means that probably small businesses are getting left out of this because he's not necessarily hearing their voices.
John, when it comes to the trade agreement, we of course have the punting of the negotiations when it comes to China and the United States. You mentioned the victory, really, of Beijing using those rare earth magnets in lieu of making sure they can loosen up export controls. Would you say Beijing has the leverage going into November?
Not necessarily. I mean, I think you have to be mindful of the fact that China is going to face higher tariffs. They're just comfortable. Their system is prepared for a level of higher tariffs, and they can deal with tariffs in the 30% range, which is where we think tariffs on China are going to end up here. However, I don't want to play down the fact that they have been able to play this critical mineral game very, very well, and the U.S. is obviously very, very sensitive to it. But this is not necessarily a positive story for the Chinese economy either.
When it comes to what the United States wants to see out of China, they're dealing with export controls, they're dealing with rare earths. The president the other day was truthing about soybeans. What else is on the list before potentially Xi and Trump can meet and potentially get to this grand bargain of a deal?
Yeah, I mean, we don't see a grand bargain. We don't think a grand bargain is necessarily the right way to describe this. We're thinking about this as a very transactional deal. So the U.S. is going to raise its tariff levels on Chinese goods. China will make some purchase commitments about market access. They're not going to fundamentally reform their economy, which was, of course, the goal in Trump 1 and the goal of some of the China hawks in this administration. But what they're going to do is make enough promises to buy enough time that they can live with these 30% tariffs and then hope to fight that out in the next presidential term. I'm not at all convinced these tariffs are going down. Even after President Trump's term is over, none of the China tariffs went down after his first term, and these things have a way of being enduring.
John, appreciate the update, the reaction from you, sir. As always, thank you. Jon Lieber there of Eurasia Group. Elizabeth Economy of the Hoover Institution and the former senior advisor for China in the Commerce Department under President Biden. Elizabeth, welcome back to the program. It's good to hear from you. I want to lead on your expertise here and your experience and something I know you're thinking about at the moment. Are we blurring the lines between national security and trade?
Yeah, I mean, I think that is a question that was clearly raised over the past week or two with President Trump's decision to reverse his administration's earlier decision, April decision, to put the export controls on NVIDIA's H20 chip. Typically you put an export control on technology that you believe could contribute to, a country or companies in that country developing military capabilities that will undermine your national security. So that was the decision that the administration made just in April. And then we saw, just earlier this month that the president reversed that decision without any explanation as to why that decision was being reversed. And I think it points to a larger challenge with this administration in that they have not yet articulated a real China strategy. We don't know whether this president considers China to continue to be the greatest long-term strategic threat, which is something that his first administration did put out there as part of a China strategy. That helps an administration set priorities, understand the trade-offs that you're going to make or not make. But without that kind of overarching framework, we don't know, where this president is coming from, where he's going, whether everything is up for negotiation moving forward.
Elizabeth, given your work in the Commerce Department, have you ever seen anything like this? Some corporation able to get their hands on a license because they're willing to give some of the revenue back to the U.S. government?
No, I mean, that was certainly a new twist. But even taking one step back from that, it's a new twist to have the head of the Bureau of Industry and Security, Jeffrey Kessler, go to London to be part of the trade negotiations with China. In the Biden administration, and frankly, in all previous administrations, you would never consider linking export controls with trade negotiations. Export controls deal with broad issues of foreign policy and national security. Tying them in some way to trade really makes no sense. But that's what this administration has opened the sort of the door to. So I think it's a bigger problem, even more than just this one-off decision. Is just this new world that we found ourselves in. And as far as the 15% revenue, the sort of NVIDIA and AMD having to give 15% of their the revenues from the sale of these chips back to the U.S. government, of course, that only sort of amplifies or reinforces the sense that somehow our national security is up for sale. Because, does that mean that all chips moving forward or even other goods that the United States, sells to China can all then be subject to some kind of new tax of some sort, and the revenues will have to come back to the U.S. government? It really is fundamentally changing the nature of the interrelationship between national security and trade, and frankly, just trade generally.
There's a number of issues brewing between these two economies. Fentanyl, China continuously buying Russian and Iranian crude, disagreements about U.S. business operations in China. When they sit down, what do you think is the U.S.'s main goal out of this relationship?
I mean, I would have said in the first Trump administration that there was an emphasis placed first on, of course, securing these big purchase agreements that, again, President Trump seems to place as a top priority. He mentioned just yesterday or the day before having China quadruple its purchases of soybeans. Of course, China's already diversified away from the U.S. It gets 70% or more of its soybeans from Brazil now because of the tariffs that the president began, the tariff war that he started when he first came into power. But I think, number one, yes, getting more purchases from the Chinese. But I think also the U.S. wants a secure and stable supply of rare earth elements from China, which are, of course, essential for both our national security and technology industries. And we saw what happened when China put the squeeze on those, earlier, just a month or two ago. Companies in the United States really began to feel the pinch. So I think that's probably the second priority. And then all of the trade adjacent issues that you just mentioned, fentanyl, China's economic support for Russia in its war of aggression against Ukraine, TikTok is still standing out there. But I think those fundamental issues around the Chinese economy, things like China's export of its overcapacity in many areas of core technologies, I think those are going to be very difficult for the Trump administration to make progress on. I don't think they have the leverage that they need, or maybe that they even think they have, to get China to sort of fundamentally change the way that it does business.
We're up against the clock here, but in the 45 seconds we have left, Elizabeth, why has it been so difficult to convince the Chinese they need to rebalance their economy when so many economists agree that it might be good for them?
I think Xi Jinping has a vision of how the Chinese economy should work, which is reliant on exports and heavy investment, investment now into core technologies. And he believes it is working for the Chinese economy and is willing to suppress Chinese consumer demand and Chinese incomes to achieve what he believes will put China in a stronger long-term footing moving forward.
Elizabeth Economy of the Hoover Institution. Elizabeth, thank you. Appreciate it as always.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.